Bernard Lawrence Madoff, known as Bernie Madoff, was a prominent figure in the financial world, a name synonymous with success and influence. He was a respected stockbroker, investor and philanthropist, admired by many for his financial acumen and charitable contributions. Madoff started his career in the 1960s, building a successful trading firm from the ground up, navigating the complexities of the financial markets with apparent ease. He gained a reputation for generating consistent returns, attracting a loyal clientele of high net worth individuals, charities and hedge funds, all eager to benefit from his expertise. Madoff's aura of success and exclusivity made him a Wall Street legend, a figure many aspired to emulate. Investors clamored to join his exclusive investment advisory business, unaware of the sinister secret behind his consistent returns, a secret that would eventually unravel. Madoff's reputation was built on a foundation of trust and exclusivity, qualities that made him a magnet for investors. He cultivated an image of success and stability, attracting investors seeking consistent, above-average returns, promising them financial security and growth. Madoff's firm, Bernard L. Madoff Investment Securities LLC, was considered one of the most prestigious on Wall Street, a beacon of financial prowess. He was a pioneer in electronic trading, a respected philanthropist, and even served as chairman of the Nasdaq stock market, further cementing his status. Madoff's success and influence within the financial industry made him a trusted advisor to many, a figure whose advice was sought after. However, beneath the surface of legitimacy lay a carefully constructed web of deceit that would have devastating consequences, a scheme that would shock the world and tarnish his legacy forever. A Ponzi scheme, named after Charles Ponzi, is a fraudulent investment operation. It promises high returns with little or no risk. Instead of generating legitimate profits, the scheme relies on money from new investors to pay off earlier investors. This creates the illusion of a profitable enterprise, attracting more unsuspecting individuals. The scheme's success hinges on a constant influx of new funds. As long as new investors join and existing investors don't withdraw their money, the illusion of profitability can be maintained. However, Ponzi schemes are inherently unsustainable. They eventually collapse when the flow of new money dries up, leaving later investors with significant losses. Bernie Madoff's Ponzi scheme was the largest in history, spanning decades and defrauding thousands of investors. Instead of investing client funds as promised, Madoff deposited the money into a single bank account, misleading everyone. He used this money to pay off earlier investors and fund his lavish lifestyle, which included mansions, luxury cars, yachts, and private jets. To maintain the illusion of a legitimate investment strategy, Madoff fabricated trading records and account statements, deceiving even the most seasoned investors. He claimed to be using a complex split-strike conversion strategy that consistently generated high returns, regardless of market conditions, which seemed too good to be true. Madoff's air of exclusivity and secrecy made it difficult for investors to question his methods, as they felt privileged to be part of his elite circle. He discouraged withdrawals, claiming it would disrupt his trading strategy, and fostered a sense of being part of an exclusive club, making investors feel special. Furthermore, Madoff cultivated an aura of exclusivity around his investment fund, making it seem like a rare opportunity. He limited participation to select individuals and institutions, creating an air of prestige and secrecy that was hard to resist. This exclusivity made investors even more eager to join and less likely to withdraw their funds, as they didn't want to lose their privileged status. Madoff's scheme flourished in an environment of trust and lack of due diligence, where people were too trusting and didn't ask the right questions. His ability to exploit this trust and the lack of oversight allowed his fraudulent activities to continue for years, causing immense financial damage. Despite the seemingly impenetrable facade, there were numerous red flags throughout the years that hinted at Madoff's fraudulent activities. Financial analysts and competitors questioned the consistency of his returns, which seemed immune to market volatility. Several individuals, including whistleblower Harry Markopoulos, raised concerns with the Securities and Exchange Commission, or SEC, about Madoff's operation. However, these warnings were largely ignored or inadequately investigated. The SEC's failure to uncover Madoff's scheme, despite receiving credible tips, raised serious questions about the agency's effectiveness in regulating the financial industry. Critics argued that the SEC was too focused on Wall Street giants and overlooked smaller firms like Madoff's, despite their potential for systemic risk. Section 5. The walls close in Madoff's downfall. The 2008 financial crisis proved to be the undoing of Madoff's elaborate scheme. As the market tumbled, investors began requesting withdrawals, putting a strain on Madoff's ability to maintain the illusion of solvency. In December 2008, Madoff confessed his crimes to his sons, who then reported him to the authorities. The news sent shockwaves through Wall Street and beyond, exposing the fragility of trust in the financial system. Section 6. The human cost victims of the Madoff scheme. The collapse of Madoff's Ponzi scheme had a devastating impact on thousands of investors. Individuals, charities, and institutions lost billions of dollars, with many seeing their life savings wiped out. The Madoff scandal highlighted the devastating human toll of financial fraud. Beyond the financial ruin, victims suffered emotional distress, damaged relationships, and loss of trust in the financial system. Section 7. Echoes of a scandal. Lessons learned. The Madoff scandal served as a stark reminder of the importance of due diligence and skepticism in financial matters. It exposed the dangers of blindly trusting financial advisors, no matter how reputable they may seem. The scandal also exposed weaknesses in the regulatory system, prompting calls for reform and increased oversight of the financial industry. Section 8. Regulatory response and reform. In the wake of the Madoff scandal, regulators faced intense scrutiny and criticism for their failure to detect and prevent the massive fraud that had been ongoing for years. The scandal exposed gaping holes in the regulatory framework, highlighting the urgent need for enhanced investor protection and stricter oversight of financial institutions to prevent such occurrences in the future. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, was partly a response to the Madoff scandal, aiming to restore trust in the financial system. The act aimed to strengthen financial regulations, increase transparency, and protect consumers from predatory lending practices, which had become rampant. Key provisions of Dodd-Frank included the creation of the Consumer Financial Protection Bureau to safeguard consumers from unfair, deceptive, or abusive practices by financial institutions, ensuring a fairer marketplace. Despite these comprehensive reforms, the Madoff scandal continues to serve as a cautionary tale, reminding investors and regulators alike of the importance of vigilance, transparency, and the ever-present potential for financial malfeasance in the complex world of finance. Section 9. The enduring legacy of the Madoff affair. The Madoff scandal left an enduring legacy on Wall Street and beyond. It shook investor confidence, exposed regulatory weaknesses, and led to calls for greater transparency and accountability in the financial industry. The scandal also had a profound impact on the victims, many of whom were left financially and emotionally devastated. While some victims were able to recover a portion of their losses through legal settlements and clawback lawsuits, many others faced financial ruin. Section 10. Conclusion. A stark reminder. The rise and fall of Bernie Madoff stands as a stark reminder of the dangers of unchecked greed and the importance of robust regulation in the financial industry. It serves as a cautionary tale about the seductive nature of get-rich-quick schemes and the devastating consequences of financial fraud. The Madoff scandal continues to resonate today, urging investors to exercise caution, conduct thorough due diligence, and demand greater transparency from financial institutions. It serves as a constant reminder that even the most sophisticated financial systems are vulnerable to fraud, and that protecting investors requires vigilance, skepticism, and a commitment to ethical conduct at all levels.